There is something that almost every American uses every single day, but very few people truly understand it. It is not made in factories. It does not require workers. It does not need warehouses. Yet every year, it generates trillions of dollars. That thing is called debt. Right now, there's a good chance you're carrying some. Credit cards, student loans, a 30-year mortgage, car loans, medical bills. You do not have to be poor to be in debt. You only need to live a normal life in America. Imagine this. You use your credit card to buy a laptop for $2,000. The bank tells you, it is fine, just pay the minimum every month. It sounds harmless, but the interest rate is 22% per year. You pay slowly. You pay a little. 1 year passes. You still owe money. 2 years pass. Still not done. 3 years pass. You have paid almost double the price of the laptop. You did not buy anything else. Yet the number keeps growing. That is compound interest. The problem is that the human brain is not designed to understand this. We are good at simple math, but we are terrible at understanding things that multiply over time. We think it will only grow a little. In reality, it does not. It grows slowly at first, then it explodes, like a snowball rolling down a mountain. Small at the beginning, disastrous in the end. That is why debt is not dangerous because of the original amount. It is dangerous because of time. Time, combined with interest, becomes a weapon. Debt is not a modern invention. More than 4,000 years ago, people were already recording debts on clay tablets. Who owed whom? How much? When it had to be paid? Very clear. But ancient societies also realized something early. If debt was allowed to pile up for too long, society would collapse. The poor would lose their land, lose their freedom, and be forced into slavery. So kings would periodically erase debts. Completely. Start over. Not because they were kind, but because without it, there would be revolts. In the Bible, there was also the idea of debt forgiveness. A time when debts were canceled. Slaves were freed. Land was returned. Ancient people understood this very well. Uncontrolled debt was a form of chains. Modern society works differently. Today, debts are rarely erased. Instead, people are taught, if you borrow, you must repay. If you do not repay, you have failed. If you do not repay, you are irresponsible. Debt is no longer just about money. It is tied to honor, to self-worth. When you owe money, you feel guilty. And when people feel guilty, they become obedient. They work overtime. They take extra jobs. They accept work they hate, all to pay off a debt. Banks and financial institutions understand this perfectly. Why erase debt when you can use it to control people? What started as a simple promise slowly became an invisible rope, binding millions of Americans, running nonstop, running to pay for the past, running to protect the present, running because there is no other choice. Debt did not become powerful overnight. It grew slowly, quietly, for centuries. At first, lending money was considered dangerous. In medieval Europe, charging interest was seen as immoral. The church called it usury, asin, making money from someone's desperation. So officially, banks were not allowed to do it. But business never stops. People found ways around the rules. They did not call it interest. They called it fees, risk compensation, service charges. Same thing, different name. By the Renaissance, powerful banking families had emerged. In Italy, in the Netherlands, in England, the Medici family in Florence became richer than many kings. Not because they conquered land, but because they lent money to governments, to monarchs, to the church itself. Whoever controlled debt, controlled politics. But lending to kings was risky. Kings could simply refuse to pay, or start a war, or change the law. So lenders demanded extremely high interest. In 17th century England, the government sometimes paid over 15%. No normal business could survive that. Then something changed. Parliament gained power over the king. Debt was no longer personal. It became national. The government, not one ruler, promised to repay. That made investors feel safe. Interest rates dropped. More people were willing to lend. Modern public debt was born. The Netherlands perfected this system. They created government bonds. Ordinary citizens could now lend money to the state. In return, they received steady interest. It sounded safe. It sounded patriotic. It worked. England copied the model. In 1694, the Bank of England was created. Its main job was simple: manage government debt, finance wars, stabilize the system. Debt and military power became connected. No loans, no army, no empire. The United States adopted the same logic. After independence, the country was deeply in debt. Many leaders wanted to erase it. Alexander Hamilton disagreed. He called national debt a blessing, a tool. If investors depended on America's survival, they would support its government. Debt would glue the nation together, and it worked. The U.S. built its financial system on this idea. Borrow, grow, expand, repeat. Wars were financed with bonds. Infrastructure was financed with loans. Economic power was built on credit. But this created a cycle. Debt funded expansion. Expansion created more debt. More debt required more growth. There was no natural stopping point, only acceleration. By the 20th century, this system went global. After World War II, the United States became the financial center of the world. In 1944, leaders met in Bretton Woods. They created two powerful institutions: the IMF, the World Bank. Officially, their mission was stability, prevent economic collapse, support development, promote cooperation. In reality, they also became enforcers. When poor countries ran out of money, they went to the IMF. Help came with conditions: cut public spending, privatize industries, open markets, reduce social programs. If you refused, no loans, no rescue. In 1997, Asia learned this the hard way. Thailand collapsed. Indonesia followed. South Korea nearly fell. IMF bailouts arrived. So did strict rules. Millions lost jobs. Companies were sold to foreign investors. National economies were reshaped. Debt was no longer just financial. It became political, a tool to influence governments. Without armies, without bombs, just contracts. And once countries were trapped, they stayed trapped. Borrow to repay old loans. Take new loans to survive. Permanente dépendance. By now, debt was not just controlling individuals. It was controlling nations. Quietly, legally, efficiently. No chance, no presence, just numbers on a screen, and signatures at the bottom of documents. In theory, debt is simple. You borrow, you repay. If you fail, you face consequences. That is what most Americans are taught. From childhood, from school, from parents, from banks. Be responsible. Pay your bills. Do not live beyond your means. But in reality, this rule is not applied equally. There are two systems, one for ordinary people, one for the powerful. When a regular person falls into debt, options are limited. You miss a payment. Your credit score drops. You pay higher interest. You lose access to loans. You get calls from collectors, letters, threats, lawsuits. Your life becomes smaller, harder, more stressful. Student loan debt is a perfect example. In the United States, over 40 million people carry student loans. Many of them are still paying in their 40s and 50s. Unlike most debt, student loans are almost impossible to erase. Even in bankruptcy, you can lose your job, get sick, get divorced. The debt stays. Medical debt works the same way. One accident, one surgery, one hospital visit, and suddenly you owe tens of thousands of dollars. Not because you were irresponsible, because you were unlucky. Now, compare that to corporations. When large companies fail, they do not get punished. They get lawyers. They get negotiations. They get protection. In the U.S., it is called Chapter 11 bankruptcy, a legal reset button. Companies keep operating. Executives keep their jobs. Investors minimize losses. Debt is restructured, sometimes erased. For individuals, bankruptcy is shame. For corporations, it is strategy. This difference became obvious in 2008. The financial crisis. Banks have been lending recklessly, packaging risky loans, selling them as safe investments, making billions. When the system collapsed, everything froze. Homes lost value. Jobs disappeared. Retirement accounts vanished. Millions of Americans lost their houses. Families were evicted. Entire neighborhoods collapsed. And what happened to the banks? They were rescued. The government spent over $700 billion, taxpayer money, to save financial institutions, the same institutions that caused the crash. Executives received bonuses. Share prices recovered. Wall Street survived. Main Street did not. This sent a clear message. If you are big enough, your debt will be forgiven. If you are small, your debt will follow you forever. Germany provides another example. Today, Germany is one of the strongest voices in Europe for strict debt rules. Balanced budgets, austerity, discipline. Countries like Greece were forced to cut pensions, wages, and healthcare to repay debt. But history tells a different story. In 1953, after World War II, Germany received massive debt forgiveness. More than half of its foreign debt was erased. Some estimates go even higher. This helped rebuild the country, restart growth, stabilize society. Without forgiveness, modern Germany might not exist. Yet this history is rarely mentioned. The same pattern appears everywhere. Debt relief for the powerful, discipline for the weak. Economist Joseph Stiglitz explains this clearly. Extreme inequality is not an accident. It is designed. When wealth concentrates at the top, political influence follows. Laws change. Regulations weaken. Taxes shift. Systems adapt. Money shapes rules. Rules protect money. A closed loop. At the same time, debt became a product. Something to sell. Credit cards. Buy now, pay later. Personal loans. Every purchase became financeable. Every desire became affordable, at least on paper. Middle-class life was rebuilt on credit. Homes, cars, college, weddings, vacations, all financed, all delayed payment. The message changed. Do not wait. Do not save. Borrow now. Figure out later. And millions did, until later arrived. With interest, with penalties, with stress. By the time people realized the trap, they were already inside it, working to pay old bills, using new debt to survive, running in place. Debt was no longer just money. It was pressure, fear, dependence, a system that rewarded those who created risk and punished those who carried it. At some point, debt stopped being personal. It stopped being something between two people, a lender, a borrower. It became something else, a product, a commodity, a thing to be traded. Banks no longer waited 30 years for mortgages to be paid. They bundled thousands of home loans together, turned them into securities, sold them to investors, pension funds, insurance companies, hedge funds. Around the world, one family's mortgage in Ohio could end up in a portfolio in Tokyo. A car loan in Texas could be owned by a fund in London. No one knew the borrower. No one cared. Only the numbers mattered. Risk was sliced, repackaged, hidden, moved, until it disappeared. Or so it seemed. This is what caused 2008. Too much debt. Too many layers. No accountability. When it collapsed, nobody knew where the damage was, because it was everywhere. But instead of slowing down, the system accelerated. Financial engineering became more complex. Algorithms replaced humans. Decisions were automated. Loans approved in seconds. No conversations. No judgment. Just data. At the same time, personal debt exploded. Credit cards. Student loans. Auto loans. Buy now, pay later apps. Everything became finance. Even groceries. Even rent. Even medical bills. People stopped thinking in prices. They started thinking in monthly payments. Can I afford $79 a month? Not. Can I afford $3,000? This shift changed behavior. Spending increased. Saving disappeared. Debt became normal, expected, invisible. Then came digital money. Cash declined. Mobile payments rose. Credit became instant. One click, one scan, one tap. Borrowing became frictionless. Now a new idea is emerging. Programmable money. Digital currencies controlled by institutions. Money that can be tracked, restricted, timed, approved. In theory, it sounds efficient. In practice, it means something else. Every transaction monitored. Every payment recorded. Every mistake permanent. Debt combined with surveillance creates a system of perfect control. No violence. No force. Just incentives. and penalties. If you comply, life is smooth. If you fail, life becomes expensive, slow, limited. The system does not hate you. It does not care about you. It has no emotions, no morality, no memory, only rules. And those rules were written by people, with interests, with power, with money. From ancient clay tablets to credit scores, from kings erasing debts to algorithms enforcing them, the logic never changed. Only the tools did. Debt was always about more than money. It was about behavior, about obedience, about shaping choices. Most people never rebel. They cannot afford to. They have payments, deadlines, balances, so they adapt. They work more, sleep less, delay dreams, postpone risks, not because they lack ambition, because they carry weight, invisible, but heavy. And that leads to the final question. Not a moral question, not a political one, a practical one. In a world where everything runs on debt, where growth depends on borrowing, where mistakes last decades, who is the system really built for? And who is it built on?